As Ben Narasin, founder and general partner of Tenacity Venture Capital. And immediately under that, it says, send me your one-line elevator pitch and ARR. I read them all. I do not invest in security, medtech, or crypto. Now, I'll tell you what not to do. Don't send me a 6-paragraph thing with a link to Calendly, which I hate, and or some video. Because what I'm going to do is hit reply and send you a picture of my profile with a circle around the thing that says one-line elevator pitch. We didn't count those in our 8,000. So the reason I ask for that is there's many reasons it might not be a fit. Some of them are obvious immediately. Now, you'd be amazed at how many people send me 6 or 7 paragraphs. I send them the picture, and they say, oh, we're building a Web3 token for blah, blah, blah. And I respond, did you not read where I said I don't do crypto? Or we're doing a health diagnostic. I'm like, or medtech? Like, you should understand that, even within the sub-segmentation of seed versus Series A, people either have specialties or when they're generalists, they have no-goes. So, everybody has a sin clause. A lot of traditional firms, they can't invest in gambling or prostitution or drugs or stuff like that or tobacco. But I also don't invest in security, medtech, or crypto. So, everything else, I'm willing to hear the pitch. But maybe you'll pitch me something I don't want to be hearing a story of something I've already invested in. If you say, I'm building the equivalent of the Divvy card, which is a big investment of mine for NEA, in Latin America, starting in Mexico, I'll say, I invested in a company called Capital that's crushing it. I'm not interested in hearing about their competitors. I don't invest in competitors, right? So, that doesn't work. Or sometimes I get pitches that we're developing a new potato chip. Yeah, I invest in tech. I thought that was understood. So when people see that you're an investor, they sometimes I think it's just spam. They literally just ingest every investor on LinkedIn and hit them with the same pitch, which proves to me they didn't do the work of actually looking into who I am or what I do, which frustrates me. But I send the picture back, and then they either respond or they don't.
Nice. Welcome, everyone, to Everyday Leadership. We have a very interesting episode lined up. In today's episode, we'll sort of dig deeper and understand venture capital. We will not just start with what venture capital is and what are some, who is a limited partner, general partner, and all the jargon surrounding venture capital. But we'll sort of understand what goes behind the scenes. How do these VC firms source entrepreneurs? And if they say yes to an entrepreneur, what happens behind the screen in sort of structuring the deal and we'll sort of dive deeper into a lot of those interesting questions that happen behind the scenes. So with that, to answer all those questions, we have a very interesting guest, Ben. Ben, why don't we just start with a quick introduction of yourself? Just introduce ourselves, who you are and what you do, and then we'll go from there.
So I'm Ben Narasin. I've been an investor, a venture investor for about 17 years now. Before that, I was an entrepreneur for about 25 years. Started one of the first .coms in 93, took that company public in 99. That was on the East Coast, primarily in New York. Moved west and got here about 20 years ago, California Bay Area, and noticed this big gap in the market between angel and venture. Angel was very slow and very small, and venture had gotten very big. So I started what ended up being one of the first 3 institutional seed funds in 2007. Did that exclusively for about 8 years, then did traditional venture for about 7 years, primarily at NEA, New Enterprise Associates, which for those that are watching that don't know, venture has historically been the largest venture firm in the world, although SoftBank will now claim that title, although they're more of a private equity shop. And then I spun out of NEA about 3 years ago to start my own seed fund with their support. And I actually have about 40 VCs who are LPs in my fund. And last point I'll make is during my 8 years in the beginning as a seed investor, I got to know well over 300 VCs because for me, it was important to learn how they did what they did. Because as a seed investor, a big part of my job is to help entrepreneurs raise their Series A. And I have been super focused on sort of the tier 1 sandhill venture firms. And those are the people I go to for my deal flow out and sometimes also for deal flow in.
Nice. And let's start at the very basic. Can you sort of help us explain what is venture capital really? And also talk about what other types of investments are out there, which are very similar to venture capital.
Well, I don't know that there are very many that are similar to venture capital at all. Venture, it's funny, when I was in Boston in school or in New York in business, I never knew anything about venture capital. In fact, the only reference I ever heard to it was in school, they called it vulture capital, which I think is an unfair characterization, but occasionally can be accurate for some individuals. But most of the folks and firms, it's not accurate at all. So venture is, I guess, in fairness, a form of private equity, or what LPs, the limited partners that invest in these sort of things, we call alternatives. So, the more traditional stuff would be stocks and bonds that you trade on a public market. So, in a private equity structure, you're investing in things that are investing themselves in private entities. So, a venture firm will raise money from investors, primarily limited, they're all limited partners. It's a GP-LP structure where, in my case, I'm the general partner. It is my job to run the fund. It is my job to do all the investing and to help the entrepreneurs. And literally, God knows how many hours a day, it's all I do. The LPs provide money for that, in return get the material portion of any upside that is achieved, but they don't have to do any day-to-day work. So the GP does all the work, the LPs provide all the money. Although the GP also provides what's called a GP commit, which is a percentage of the fund. The norm in the industry is that a general partner will put in 1% of the fund. So if you raised a $100 fund, you would put in $1. $100 million fund, you'd put in $1 million. I actually put in a 10% GP commit because, having done this for 14 years before I raised the fund and 17 years now, I already knew that it was a very lucrative thing for me, and I wanted as much of my own personal capital involved as possible. So the LPs give the GP money. The GPs then go out and invest in entrepreneurs in venture capital. Venture capital is very specifically about investing in startups and almost exclusively investing in tech startups. So the goal for a general partner like myself is to find awesome founders that they believe are going to build enormous businesses and invest in them early in their journey. A traditional Series A investor, the NEAs, Sequoia, Benchmark, Excel, on and on and on. These groups will typically start their investing process at Series A. After somebody like me, I will have seeded the company. If it went further, then as far as I needed to or further, then I would take it to those organizations. These days, it almost has to be further because the bar keeps going up. They would typically look to put in money to buy 20% of the company that they're investing in. They're minority investors. They would reserve a certain amount to continue investing later. And so they become minority partners. They take a board seat, and they, at varying levels will help with the business. But realistically, their help usually ends up on the board, and that happens once a quarter. So, even the most helpful VC isn't that helpful. In fact, a friend of mine, Mike Maples, once said, rule number one for me, he's another seed investor, got started in this a couple years after I did. He said, rule number one for me is do no harm. And I think that rule alone puts me in the top 10% of investors. I wouldn't know if I go top 10%, but it probably is top quartile. I mean, it is unfortunately the case. There's a lot of investors that are not value add. But when you have so let me pause there for a second, because I want to explain one other part of this. Venture is made up of different stages. So while venture capital is novel and distinct and different than other alternatives or private equity mechanisms, within venture capital, there are specific subsets. So you've got pre-seed and seed. That's where I play primarily in seed. Pre-seed is typically like somebody with an idea, very similar to a friends and family round these days, $500,000 to $1.5 million. Seed, you actually have a product built. You probably have some traction. I typically see companies would call it 400,000 to $1 million of revenue. And I personally write checks between $1 and $3 million, and I lead those rounds. Most of the time I can co-lead. But they might be raising anywhere from $2 to $6 million in total. Next is early stage venture capital, traditionally anchored by Series A. These are the larger institutions. NEA, as an example, when I was there, was investing on about a $3.7 billion fund. And they'll do a Series A these days of, call it 8 to 18, sometimes more. We did a $29 million Series A on a $100 million pre in one of my companies. But Series A is the first old school, traditional, big shop venture round. Early stage folks often will sometimes do Bs as well, which is the next round. Everything has sort of gotten earlier now. So seed is like A used to be, A is like B used to be, et cetera, et cetera. And then you go into what I would call later stage, Cs and Ds. These used to be the last round before the IPO. but now companies stay private longer, so it can go far later, DEF. And those were historically dominated by late stage venture funds like Institutional Venture Partners, IVP, started by a friend of mine, Norm Fogelsong. Or more recently, like in the last 7-8 years, you even saw players like Fidelity and T. Rowe coming in and putting money to work because they weren't getting all the exposure they wanted on the IPO. Then you get to the company to the point where it either gets sold or goes public, and that's a totally different type of investor. Public markets investors, has nothing to do with what venture does. Having said that, things are changing. Now many venture firms are changing to what's called an RIA, Registered Investment Advisor, so they can actually hold and potentially buy public stocks in some of their companies so they can have a longer term approach. Sequoia did this recently. NEA did this recently. Personally, I like it when people stick to their knitting. I'm a seed investor. I'm not a Series A guy. My job is to find phenomenal founders, help them as best I can, and take them to the right people at the right time if they're ready. And the Series A folks, in my view, should be helping with that stage. Late stage guys and gals are great for late stage. And once it gets to public, that's somebody else's job. But net, all things evolve. And as people succeed, they want to do more things and grow their AUM, assets under management. Because the last point I'll make to you is venture firms get paid two things. They get paid fee and they get paid carry. So you might hear the term 2 and 20. This means they get 2% of the money they have under management every year as a fee. On a $100 million fund, that would be $2 million. They use that to pay all the bills of running the business, renting a building and hiring people and blah, blah, blah. The 20% is what they make on any profit the fund returns after they've paid back all their investors. Now, the thing to understand is the fees are temporary. I don't have a $100 million fund. I have a smaller fund. I have a $60 million fund. But if I made $2 million a year on my $100 million fund for 10 years, $20 million, that would sound great. I have to give all that back before I make carry. And material wealth is created from carry. When you have a multiple on your invested capital. Let's use real simple math. Let's say you had a $100 million fund and you returned $300 million. Well, $200 million profit, you keep 20% of that. That's a little better than the fees. So, but as companies get bigger and bigger and can raise more and more capital, I do often see that people expand their asset base because they do want those fees. Could have an argument about whether that's the most effective way to run a business, but it's pretty common.
Awesome. That's such a great introduction to this entire VC world. But I have a few follow-up questions there. So can we start with how do you source these LPs? Are these very invite-only people who generally pitch in to your fund, or how does it work? And another question,
It's sort of, I was fortunate. Well, so because I had been doing this for 14 years before I raised my first fund, I had a very in-depth track record. A track record I've been told is very good. So I was able to show potential LPs what my history had been like, and they could decide if they felt like I was someone they wanted to bet on in the future. But generating capital from LPs when you're at the beginning, I just raised a fund one, is just a sales pipeline. I know people that made thousands of calls. I was fortunate in that it only took me 25 days to raise the first half of my fund. I thought it would take 1 to 2 years. And then I sort of slowed things down and decided I needed to focus more on quality, not just quantity. But I raised the whole fund in about a quarter, which I've been told may have been a world record for speed, which would be awesome, but it doesn't pay my bills. I mean, it doesn't change anything. My job is to go out and find great founders. That's what I do for a living. Having said that, the normal course is somebody goes out, they have a reason for being, they build their deck, and they build a pipeline. It's everything from direct phone calls and emails to their sort of trade shows of sorts. I try not to do those, where you can pitch LPs. There's maybe 2 of those that I believe are valuable out of the many, many, many that are out there. You ask for references. Because I had 40 LPs that were VCs themselves, I would often ask them who they liked. Like the relationship with a VP, an LP to GP is quite long. A fund normally has a 10-year life plus 2 automatic 1-year renewals. So you're looking at 12 years. But as companies are staying longer, staying private longer, I'm hearing people say, realistically, it could be 20 years. I've seen liquidity in anywhere from, I used to say it was 7 to 10 years. I think it's more 7 to 15. But I do have one investment left from my 2008, 9, and 10 portfolio that's still around. So, it can take a long, long time. And so you are it's not like you're with that person. You are, however, attached to them financially for quite some time. And so you both want to make the right decision. I want to have LPs that hopefully can be useful to me in more ways than just capital. And LPs want to have someone they can continue investing in. Most LPs believe in what's called, sort of vintage diversification. Normally an LP will say if they're going to commit to one fund, they're probably committing to two, maybe even three, because they've put all the time in to do the research to decide if this is an investment they want to make. They're likely going to stick with it. Also, it's very unrealistic to have anything more than hints of how good a VC is after their first fund has been, exhausted and they're going out to raise fund two. So, there's what people look for are, at the end of the day, an investor's giving you money so they get more than that back. But we just talked about this taking 10 years to get to liquidity. A fund is typically invested in about 3 years in the normal course. So I will probably take between 3 and 4 years to invest my entire fund. I'll probably start raising fund two, I don't know, some point this year. When that happens, I will not have had any liquidity. I will not have paid any money to my LPs. I will have, and so people look at different things. They look at IRR, they look at, sort of the return, the interest rate equivalent. Realistically, the data is showing the number one way you can understand if an early stage VC that's early in their career, I'm not early in my career, but I'm early in this fund, is going to do well, is what percentage of their companies have had markups, how effective they've been in helping their entrepreneurs raise money. If somebody funds 10 companies and none of them have gotten markups after 3 years, I'd say it's pretty unlikely you're going to see anything interesting out of that person over time. I'm fortunate in that I've funded phenomenal entrepreneurs. And right now, I've got 18 companies I've funded in a little under 3 years. As of this week, 14 have raised money, follow-on rounds, markups after us, 13 markups, 1 flat round. And considering the last 2 years, we're up to 50% down rounds and flat rounds. I mean, that's extremely impressive of my entrepreneurs to be able to achieve that. If I can be credited for anything, it's the picking. But the real work, once you pick them, it's the entrepreneurs. They're the ones running these races.
Nice. And when LPs trust in you, and then when they invest their money, and can they disengage from this arrangement? Can they pull back, or is it like a one-time deal?
Oh, no, they're done.
They're
Well,
done.
I mean, so they get to make, so my fund's normal minimum is $1 million. I created a structure for smaller value-added people that's slightly different, and they put all the money in up front. But in the $1 million normal model of a traditional LP, you get capital calls. The fund asks you for money each time it needs money to make an investment or cover its costs until the money you've committed is deployed. So let's say it's $1 million minimum and it's a 4-year deployment period. You're going to end up putting in roughly $250,000 a year. But what I always tell, I have a mix of traditional LPs and fund of funds and family offices and some high net worths and exited entrepreneurs and friends. And whenever there's a high net worth that doesn't have a lot of history in venture, I say, look, there's some things you need to understand. One, this is risk capital. I've done really well over the last 17 years. I mean, literally, somebody looked at my portfolio track record and said, I think that's top 1% delivered returns. And I was like, well, I don't know. And I talked to Cambridge and they said, well, it looks right. We'd have to check the vintages. So I've never had that work done. I don't even know if I'm allowed to. But net, point is, I've done really well. But that doesn't mean I'm going to do really well in the future. I mean, these companies are always binary. I have lost money on about a third of the companies I've invested in. Now, that is much lower than venture on average, which is 40% plus. And I don't think it's a problem at all. But, it could change. So this is all risk capital, number one. Number two, the money comes in, it's gone. You can't get it back. There is no right of rescission. You can't put $1 million in and then say, oops, I want to buy a boat. Well, good luck. I mean, you can go talk to the individual entrepreneurs and see if they want to give you some money back, but I can guarantee you the answer is probably going to be no. So once you're in, you're in. And it's a solid 10 years before you're going to see liquidity. So this is a place for people with long dated capital, money that is being put in for long-term reward. There's no dividends, there's no cash flow. We only get liquid when a company either sells or goes public. And unless something went wrong, that is not happening quickly. I would argue that if somebody's at my stage with Fund 1 and we're 3 years in and they've had liquidity, things didn't go as planned. I had, Lending Club, one of the very first investments I ever made. It was the biggest tech IPO of the decade when it went out. That was about a 7-8 year journey. And that was in the old days. If they'd exited in 2 years, you think it would have been the biggest tech IPO of the decade? Absolutely not. So this is a game that requires patience and risk tolerance. And, I keep my LPs informed every quarter. I do two things. I give them a narrative. I write up any new investments we've made. I give them an update of the existing companies in the portfolio. And my back office, which is a professional organization I pay to do all of the work on the financials, will give them the current status of the pluses and minuses and where each investment has been marked and the expenses that have been drawn down and where they sit. If it was $1 million commitment, hey, you're 632,000 in, and this is how much is left. So yeah, it's a very illiquid form of investment.
Nice. I think two things, right? So one, having such a medium to get investments from is a blessing for a lot of the early founders. And it's also, on the other hand, it's more like invest and forget for a lot of these LPs, which is good and bad. I think they can be hands off while just wait.
I mean, look, when I was talking about my friend who said, my first rule is do no harm, neutral is better than negative, right? That's like, I give my folks updates, but I'm not expecting them to like reach out every week and chit chat about some nuanced detail of one of the portfolio companies. If they can help, I'm always looking for that. I have used my LPs to due diligence, to get client relationships, to get introductions. I'd always like to find more value than just capital from my LPs. But realistically, a lot of them, that's not going to be realistic. And the only thing you don't want is negative value. I've only had that happen once. So far, so good.
Nice. And now let's talk about sourcing. Like, how do you find those awesome entrepreneurs? And that looks pretty challenging. So could you talk about your playbook? It's not
easy.
Yeah.
I mean, look, secrets. I will tell you that last year, I used to have a younger guy that worked with me for about a year and a half, and he kept track of our deal flow. And he told me at one point that we were on track to see 8,000 pitches in 2023. We funded 3. So I've gone back and I've looked at where deals come from, and I've realized that, because those 8,000 pitches weren't 8,000 1-hour meetings with the founder. Those are everything from a demo day that lasts 3 minutes per pitch to 20 minutes here to half an hour there, whatever. And I did not see a lot of value coming from those online demo days. I mean, Y Combinator is its own unique creature. I've funded a bunch of companies out of there, although I have plenty of issues with them. But most of my deal flow of any quality at all comes from in person. So I have reaccelerated into going out to trade shows and conferences and meetups. I traveled almost the entire month of January. And it's not because I'll necessarily even meet the entrepreneurs I'm looking for there. Sometimes I will meet somebody attached to that entrepreneur. So last year, remember I said we did 3 deals out of the 8,000 pace? One of them came from a conference in LA called the Montgomery Conference. The Montgomery Conference is a very late stage conference. It's one round before the IPO. There are no entrepreneurs there I'm going to be funding. But I did run into a friend of mine who is a VC, who's now running a strategic venture arm. And he had a business he was thinking about funding, and we worked on it together, and we ended up splitting the deal. So, other times I meet an entrepreneur that knows another entrepreneur, maybe they're later stage, but they're doing some angel investing. So the bottom line is you just have to kiss every frog and turn over every rock. I just booked today another trip. So I was on the road almost all of January. Then I'm back here for February. March comes around. I've got a 5-city tour. I'm like, it's crazy. It's just like I literally go from one place to the next, all these 5 a.m. flights. I go from here to Kentucky, and I go from, then from Kentucky to Las Vegas for a fintech meetup. And then I go from there to LA for the Montgomery Conference. And I go from there to, Salt Lake City from, VC Mingle. And then I come, it's like, so you just have to, there's an old saying, might be smarter, but you can't outwork me. You just have to work really hard. If you want to find great stuff, and look, there's probably ways to use all kinds of algorithmic intelligence to detect some signal, but everybody has their own way of doing business. And mine is a get out there and meet human beings way of doing it. And
nice.
That's also, by the way, reason I wanted to say yes to you. Like, I'm always looking for an opportunity to spread the word, because if this conversation touches the nerve of one phenomenal founder that reaches out to me either, through Twitter or on LinkedIn, both of which are easy, and I read all of them. Like, great. I mean, then that's yet another founder I get to hear the story from.
Nice. So just curious. So you mentioned about investing in 3 companies from about 8,000 pitches. Did you say that, did you go through all those 8,000 pitches and then
Well, we
shortlisted 3
were
of them?
on pace to see 8,000. By the time I changed my mind, we'd probably seen half of them. I would,
Hmm.
just to make it easy, I'm going to guess we saw 3,000 pitches to do 3.
Hmm.
So I often tell entrepreneurs when I'm getting serious enough to continue the meeting, by the way, there's only a handful of companies that even make it to a second meeting.
Hmm.
But when they do, I try to tell them, look, like, we're not funding the top 1% of the entrepreneurs we come across. We're funding the top 1 basis point of the entrepreneurs we come across. Because I want them to understand, right or wrong, I am outrageously picky. And if you make it through this gauntlet, you're one of a very special tribe of awesome founders that, so far have proven me right. I mean, they're doing a tremendous job, as I talked about, with their ability to look. Markups and new rounds aren't success. They're just more fuel to keep going. They're very positive indicators that you're doing things in a way that are intriguing to a lot of other people, because otherwise they wouldn't have paid more and they wouldn't have put more money up.
Nice. And let's say if there's some founder watching this podcast tomorrow, one wants to somehow reach out to you with his pitch, what do you suggest is the best way of getting your attention?
As I said, I was going to update my name on here, but I don't know how to. So my last name is spelled Narasin, Narasin. Similarly, you'll put it in the notes somewhere. And if you go on LinkedIn, I'm one of one in terms of Narasins. Tenacity Venture Capital doesn't have a website. We do have a LinkedIn page. If you send me a DM on LinkedIn, I'm going to get it. If you send me a DM on Twitter, which is @bnarasin, I'm going to get it. And and by the way, here's a tip. So on LinkedIn, I have my profile picture. It's actually an icon. I don't think I've configured it here, so I can't. If I mute the camera, it's whatever. It's from one of my companies called Genies out of LA. And underneath it, it says Ben Narasin, founder and general partner, Tenacity Venture Capital. And immediately under that, it says, send me your 1-line elevator pitch and ARR. I read them all. I do not invest in security, med tech, or crypto. Now, I'll tell you what not to do. Don't send me a 6-paragraph thing with a link to Calendly, which I hate, and or some video. Because what I'm going to do is hit reply and send you a picture of my profile with a circle around the thing that says 1-line elevator pitch. We didn't count those in our 8,000, by the way. So the reason I ask for that is there's many reasons it might not be a fit. Some of them are obvious immediately. You'd be amazed at how many people send me 6 or 7 paragraphs. I send them the picture and they say, oh, we're building a Web3 token for blah, blah, blah. And I respond, did you not read where I said I don't do crypto? Or we're doing a health diagnostic. I'm like, or med tech? Like, you should understand that, even within the sub-segmentation of seed versus Series A, people either have specialties or when they're generalists, they have no-go zones. So like everybody has a sin clause. A lot of traditional firms, they can't invest in gambling or prostitution or drugs or stuff like that or tobacco. But I also don't invest in security, med tech, or crypto. So, everything else, I'm willing to hear the pitch. But maybe you'll pitch me something I don't want to be hearing a story of something I've already invested in. If you say I'm building the equivalent of the Divvy card, which was a big investment of mine for NEA, in Latin America, starting in Mexico, I'll say I invested in a company called Capital that's crushing it. I'm not interested in hearing about their competitors. I don't invest in competitors, right? So, that doesn't work. Or sometimes I get pitches that we're developing a new potato chip. Yeah, I invest in tech. I thought that was understood. So when people see that you're an investor, they sometimes I think it's just spam. They literally just ingest every investor on LinkedIn and hit them with the same pitch, which proves to me they didn't do the work of actually looking into who I am or what I do, which frustrates me. But I send the picture back and then they either respond or they don't.
Nice. That totally makes sense. And let's just sort of talk about the process on your end. Let's say you received a one-liner, you like the founder, and let's say potentially you ended up investing into that founder. Could you talk about what happens on your end between you liking that one-liner to you investing into that founder?
Sure. I mean, look, I don't make quick decisions. So I met a founder I liked this week. He's in the gaming space. We were supposed to spend an hour together. We ended up spending more. I often say to people, look, I can't say yes in one meeting. I can definitely say no in one meeting, or I can say I want to spend more time with you. This is the first new founder I met this year that I wanted to spend more time with. So I met him across the street from my house. He walked around my house. I showed him some games. Anyway, we talked some more. So now, because he's a gaming founder, I want to see the game. I brought in somebody else that's deeply knowledgeable in the space that I want to meet him. Basically, it's just all different types of diligence. The number one form of diligence is spending more time with the founder. The more time you can spend with the founder, the better. And you want to just learn, look, half the questions VCs ask aren't for the answer, although the answer is useful. It's to see how you think. I'll use an example. I spent a bunch of time with a founder, I think it was probably end of last year, going into this year, doing a generative AI business. Now, it's extremely hard for me to see how you protect a business built on an open engine. I'm not saying somebody won't win, but in the US, at the beginning of the internal combustion engine, supposedly there were 2,000 car companies. I know there are not 2,000 now. So why am I so smart that I'm going to be able to pick Ford? So the way I think about generative AI is anybody can use this engine. Show me why you're going to win and show me why you're going to protect that win. And so, I asked, how are you going to do that? And there's no answer you can give me that answers the question. This is not the formula for water is H2O. This is just a philosophical thought process. And you're going to tell me what you think. In the end, I thought his answer was okay, but not particularly compelling. Now, did that get me not to get there? Well, nobody knows the answer yet, but people have their ideas. One of my favorite stolen phrases in venture is firm on vision, flexible on path. You know where you want to get. You just may have to change the way you're going to get there. It's like the movie Planes, Trains, and Automobiles. Like the flight gets canceled, you try to get on a train. The train won't run, you try to get on a bus. The bus won't work, you try to rent a car. You just have to get to your destination. And so that series of conversations is useful. Finding people that are expert in the category they're in is useful. I often call some of the VCs I work with where they're experts in this to get their point of view. I call people in the industry. I might do a 3-way call on Zoom or, with the founder and the person that's expert in the industry. Then if it ends up being something I want to do, then we start talking about, if we haven't already, what sort of terms we need to be able to reach. In the old days, if a founder said it was X, you pretty much knew it was either X or you had to walk away. I think that's changed. I think founders have figured out it's a lot harder to raise money now, and maybe their valuation in their head is a little bit stuck in 2 years ago. So sometimes I'll be like, well, I don't think I can pay X. As an example, there was a company, I won't name it specifically, but I said, look, I didn't give them a term sheet. I said, I think this is going to be interesting. I think you're the right founder. I just don't know if we're going to, there's a bunch of other stuff, but, net, if I get there, I would be willing to pay $10 million post. He came back after a bunch more conversations and said, I actually have 2 people that are willing to pay 16. And I said, you know what? 10 was gracious. It should have been 8. So if you get 16, you go for it, man, because I'm not paying a penny more than 10. So we didn't do that deal. Now, he said, why would I go with you for less versus these other people? And I said, well, there's 2 reasons. One, they're bidding high because they have to, right? If Sequoia is competing for a deal, they're not offering you more money than the other people. They're a better player, okay? I'm going to be able to do more for you than the folks I assume you're getting bids from. So if I'm bidding against my peers, it would be very surprising if there was that big of a spread. But a $10 to $16 million spread on a company that's pre-launch, pre-revenue, where 8 was going to be more than friendly. Yeah, this is, I'm not playing against other tier ones at that point. But it's very hard to convince an entrepreneur to take that big of a spread. I have stories where I can show why it has been painful for somebody to take the larger price early, and it suffered through all kinds of problems later. But in the moment, it's almost impossible to bridge that gap. Then nice. If we're going to see eye to eye, because I want to know that, as I said, I didn't give this guy a term sheet. I want to know that I'm going to give you a term sheet you can actually accept. If we're at 10, if I'm at 10 and you're at 16, I don't need to give you a term sheet. What's the point? You're going to take the other guy's deal. But if you want my deal and you say, but I need to see it in writing, no problem. So by the way, of the 19 term sheets I've issued, we've won 18 of those deals. The one we lost to an M&A event. They actually merged with another company. So I give you a term sheet. I want to go through it with you. I usually, before I give it to you, talk you through all the clauses I think you need to understand if you're a first-time founder and tell you the specifics of each one. I have some proprietary asks, things I need to see because I've been burned. And so I tell you why. I tell you where that came from. I walk you through everything. And I want to do equity rounds. Very rarely will I participate in a safe, but it can work if I have a side letter. But normally, for many reasons that I think are more to the benefit of the entrepreneur than to me, I want to do an equity round. And I give you the term sheet. If you sign the term sheet, then it's about a 30-day process. It gets flipped over to the lawyers. They have to do their version of diligence, which is like checking your charter and Delaware registration and your option issues and whatever, all the stuff that I'm not going to do. Then at the end, they come back to me and they say, and by the way, I say to entrepreneurs, once I give you the term sheet and you sign it and I sign it, it's up to the lawyers. Okay, you're going to create a binding document, blah, blah, blah. We use what are called NVCA standard terms. So it should be super easy and fast, but lawyers have to get paid. So there's always something. So I'm like, let the lawyers battle it out on their own. I don't need to hear about it. So the lawyers do their little back and forth dance for a while. And then when it comes down to the points that they cannot get past, I say, let's get on the phone, you and me and your lawyer and my lawyer, let's hammer it out. We pound through it. By the way, worst thing you can have a lawyer do is try to improve your deal. A lawyer's job is to document what you agreed to as a business person, period. If you agreed to something illegal, they should tell you and get you not to do that. But it's not their job to improve the deal. You made the deal. They document the deal, period. Nothing more frustrating. Anyway, then at that point, everybody signs off on everything. The final docs are done. The final docs are signed. A background check was done along the way, blah, blah, blah. We wire the money and we're in business together. Couple of things that are somewhat novel about me. I don't take board seats. It just doesn't scale as a seed investor. However, I do ask for the right to a board seat. I just don't execute on that for the most part. That's more of a just in case when it comes time for the Series A for a variety of reasons. I will often attend as an observer. We're also a one and done fund. We only invest once, so we don't reserve for the future, but you don't have to think about us for future dilution. And I tell my entrepreneurs, I need to see you once a month. You can see me as many times as you want. Every first Monday of every month, I do a call with every single one of my founders, checking in, cash in the bank, burn rate, revenue, what's going well, what's going poorly, where can I help? If they want to talk to me more than that, that is fine. Many of them do. A lot of texts, a lot of calls. I'm there as needed. I have one founder I play Call of Duty with. We chit chat on the headset. So, I don't really have a life outside of my founders and my family. Literally, the only thing I have outside of my founders and my family is the fact that I do play Call of Duty at night to burn off some steam. I like to read, as you can probably tell by me sitting in my library. But, that's it. I don't have hobbies. I don't like sports. I don't care about music. I don't need to go to a concert. I don't need to play golf. So pretty much if it's the weekend and a founder wants to come by, great. I built out a sunken fire pit where we can drink some whiskey, smoke cigars if they want. It's a lot of fun. It's a good way to have a meeting.
Awesome. That's an awesome part so far. We've come to the last section of this part. I sort of asked some of more like a rapid fire questions, and then we'll sort of end on that note. My first question there is, what is that one favorite book of yours that you would recommend to all other
right
entrepreneurs?
Now, the only book I've ever bought multiple copies of for founders is called Amp It Up by Sludman. It's an awesome book. Before that, the only book I bought multiple copies of wasn't for founders, it was for VCs, and that was Atlas Shrugged by Ayn Rand, because it was 2008 and the world was crumbling. And I was like, you want to know what the world's going to look like? Here's the book. But generally, I often say to founders, you either read nothing or everything, because you either have no time and you just don't bother with a lot of the online crap. Although there's good quality stuff online. I write for online publications, so I should not have said it that way. But if you're going to read, don't limit yourself. The idea that helped me change my view of how the internet would evolve in a way that materially impacted our ability to go public. He's a little book in paperback form sitting right up there called Snow Crash by Neil Stephenson. It's a hard science fiction book that helped me change my view of how the world would change. And that was critical. But, Ralph Waldo Emerson, awesome. I've never read an entire book by him. I read one piece by him. It's called Self-Reliance. That touched my heart. Like that was like, yes, this is so true to every total, it just like really helped me when I was an entrepreneur. Just it resonated with me. There's a book called The Road Less Traveled, also very helpful to me. Not a book, I only read about half of it. Gets a little too religious and odd for me, but the beginning of it's great. The beginning of it's simple. It says the following: life sucks for everybody. Get over it and figure out how to get past it. Obviously, it took chapters and chapters and chapters to say that, but it's like life is not a slow moving marathon run. It's a series of hurdles. And if you get to that hurdle and you stop, he didn't put it this way, you're a loser and you're going to lose. You've got to figure out a way to get over the hurdle. It's just life. Everybody has it hard. And then it's just they have it hard in different ways. I mean, this is random, but who's that? The prince from England that moved here and married a woman that's an actress. And he wrote a book. It's called like Spare. There's an old saying in the certain type of folks, an heir and a spare, where you have a firstborn son and you have another one just in case. So apparently he's quite upset, that he's the spare. Like, oh my God, you're the prince. You were the prince of England and you've got troubles? Wow. Okay, let me introduce you to people with real troubles. But like, it doesn't matter who you are. Your life is hard in some way, or at least you perceive it to be.
Nice. Well said. And who is your favorite entrepreneur these days?
Oh, they're all great. I mean, that's like the old saying of which are your favorite kids. It varies by day. My favorite entrepreneur at any given day is the one that just crushed it, either by raising a phenomenal round or turning in outsized numbers or fighting through some hardship. But like, look, of the 18 founders I have funded, I think of them as 15 are green light, 15 are getting it done, kicking ass. One is red light and 2 are yellow. That's a good ratio. But net, like, it's funny. One of my LPs said to me, this old European guy, I really like him. He's funny. He's got this accent. He said, Benjamin, which one is the fund returner? And I was like, I know it's very common for people to look at a fund and because of power law, assume one company is going to return the fund. But I have never funded a company I didn't think could be a fund returner. I've never funded a company that I don't think can return the entire fund in one fell swoop. And right now, I still feel that way about 14 or 15 of the 18 companies. So does that mean I'm going to have 14 or 15 fund returners? Absolutely not. Statistically impossible, or at least highly improbable. But man, I don't see any reason why I can't have a few, because these people are just kicking butt. I was about to say guys, but it's guys and girls. So, these people are just doing a phenomenal job.
Nice. And finally, what is that favorite life hack that for you that sort of helped the most? Something that you figured out in your life that sort of helped you.
I think the point I made before of life is hard for everybody. Just get over it. Like there's a saying I heard once, which was when you lack a property, assume it of yourself. So as an example, I was trying to buy a company in England and I had only 48 hours to do everything. It took 2 days of all-nighters, 48 hours. And I'm not a checklist kind of guy. I'm this looks organized, but it took me a month to get this organized. It's normally piles. And so I woke up every morning. I said, man, I am an organized checklist kind of guy. And I made my list to make sure I didn't miss anything. So I believe at the end of the day, Tenacity, the name of my fund, is the only secret to entrepreneurial success. Brilliance is assumed, or I would not have funded you. A great idea is assumed, or I would not have funded you. And a huge market's assumed, or I wouldn't have funded you. The difference between success and failure often boils down to whether you can get back up after you get knocked down and fight through it. It is impossible to beat someone that refuses to be beaten. And eventually, I'm not saying you will never lose. There comes a time when it becomes illogical to continue to fight a fight. But, there's a huge difference between getting knocked down once and lying on the mat and getting back up. Because entrepreneurship is an incredibly hard thing. And if you're not ready to deal with hard, really, really hard. I guess if I were to turn that into a life hack, I constantly try to make things harder on myself. Brutally cold showers every morning, which I've actually gotten a little tired of because I would prefer some warmth. Or, I I'm swinging a sledgehammer or an axe or taking stairs instead of elevators. I'm always looking for, how do I make the thing I'm doing a little bit harder? Because mainly that's about increasing my longevity and being healthy. But it's true in business as well. Embrace the hard. Other people will run away from the hard. Make the hard your opportunity by grabbing it, attacking it, figuring it out, getting past it. Use hard as an advantage because so many other people will give up.
Awesome. That's awesome. And finally, really appreciate your time. I think this was one of my favorite episodes already. I think thank you for all those valuable insights on venture capital. And yeah, really appreciate your time today on the spot, Ben.
Not at all. Hopefully, you'll give everybody the way to find me. It's Ben Narasin, Narasin, and you can find me on any of those social medias that aren't for young people. No
Perfect.
TikTok. All right. Take care.
Thanks. Bye.